So what I'm basically doing is I'm saying, okay, you have all of these stocks with different PE ratios. Let's start off with figuring out what the average PE ratio is, right? And I just want to be very clear that ChatGPT is by no means perfect. You always have to check its output, right? So here it says the average forward PE ratio of the S&P 500 based on the data provided is approximately 34 times forward earnings. Now, I happen to know that the S&P 500 is trading at about 21, 22 times forward earnings. So the fact that it's telling me it's 34, something is wrong. And this is really where, once you spend a little bit of time doing the work and working with this data, you'll start to realize, certain things. And it comes down to two things, right? There's a couple of outliers. Boeing has a forward P ratio of 3,251. And I think there's another company somewhere here. Let's see if I can find it. Here, VTR. I'm not even sure what stock that is. It has a forward PE ratio of 2,500. And these two outliers are effectively skewing all the results. So I'm just going to say, are there any outliers in this forward PE ratio? And as you can see, I'm basically talking to ChatGPT like I have a research analyst sitting right next to me whose job is to, read this data and figure it out for me. And it says, based on this data, there are 32 outliers, and it kind of gives me this Boeing at 3,200, Ventas at 2,500, CoStar Group at 125. CoStar Group is probably, that's a small company. That's probably reasonable, but I think Boeing and Ventas are kind of the two that are the real outliers. So let's remove the top two outliers and calculate the forward PE ratio average again. So as you can see, I basically talk to it like I have a research analyst sitting next to me, and I'm basically working through it. So now it's saying, okay, after removing the top two outliers, the average forward PE ratio is 22.85. That sounds a lot better than the 34 times forward earnings. 22 is much closer to what I believe is the true number. Okay, so now that we've got that number, so we've got an average forward PE ratio. Okay, so that gives me a baseline for if I'm looking at a stock, let's say I'm looking at Uber. Uber is trading at 52 times forward earnings. Okay, now I know what I'm comparing it to. The average is 22, Uber is at 52. Uber is clearly well above the average. And then if I'm looking at a stock like United Airlines, where it's trading at about 5 times forward earnings, I know it's well below average, right? That's just a good starting point to determine, okay, what's the average and where is the stock that I'm looking at in comparison to that average? Now, how do you determine whether a stock is trading above or below average? Should it trade above average? Should it trade below average? Well, that's really where we look at how fast do we expect companies to grow and how profitable are those companies, right? So that's really where we turn to these two columns, which are expected future EPS growth rate and expected revenue growth rate. So what I'm going to say is, okay, calculate for me the median forward EPS growth rate and the median future revenue growth rate, okay? Just so that I have a baseline for those two as well. So now it's telling me the median forward EPS growth rate is 9.9 and the forward revenue growth rate is 4.8. Okay, so that gives me a baseline, right? So out of the average S&P 500 stock, the median growth expected is about 10%, right? So that's the median stock is expected to grow earnings over the next couple of years by about 10% per year, and they're expecting to grow revenues by about 5% per year. So when I look at any stock, let's say I'm looking at, let's see, what's a stock? Let's look at American Airlines, right? Its forward PE ratio is 5.19%, so 5 times forward earnings, very low. And what you can see here is that EPS growth rate of 18.49% is actually well above the median. The revenue growth rate is just right around the median, right? And then what we're going to look at is margins, and that's the last part that we're going to look at. So let's take a look at what is the average net margins for the S&P 500 stock. And then we'll get a baseline net margins. The average net margin is 13%, right? So the average S&P 500 stock, for every $1 they generate in revenue, they earn 13 cents in net profits, right? So then we can use that also as a gauge to say, okay, is the company growing faster than expected, or I'm sorry, growing faster than average or slower than average? And is it more profitable, meaning is it more efficient at earning profits or less efficient at earning profits than the average S&P 500 stock? And you'll quickly see, the reason that American Airlines is trading at such a low valuation, even though it's got, either inline growth or faster than expected growth, is because its net margins are so razor thin, less than 1%. So for every $1 they generate in revenue, they actually generate less than 1 cent in net profits. I don't know how margins get any thinner than that, but because margins are so thin, that's why companies like American Airlines or airlines in general trade at very, very low valuations because of how thin their margins are. Okay.